Hi everyone, Tracy Amo here. I want to share a concept with you that we use in the life insurance business called the X curve. And it's something that can be used to help you determine what type and how much life insurance you need. So on this side, on this axis, we have liabilities. Over here, we have assets. And so when we first start out in life, we haven't saved much money, okay? We have a lot of liabilities. We have children, we've bought a house, a car, whatever, we're in debt, right? And so any life insurance is really intended to cover your obligations because you have not yet become self-insured or saved enough money to where you're covered for all of your liabilities. And so in life, your need, whenever you first start out, your need for life insurance is high. And as you go through life, your need for life insurance should diminish because you pay down debt, your children leave for school, you paid their college, whatever. So your need for life insurance should go down. Conversely, as you save money, your need for retirement goes up because you're approaching that retirement age. And here, I just draw an arbitrary 65 age is where these two should sort of intersect, right? So when somebody's helping you with life insurance, the question is typically, well, what type and how much do you need? So you have some agents that will sell you just term insurance. A term is for a particular period of time. There's another video I created that shows the difference between term and permanent. There's some that only sell term, okay, which is for a particular period of time. Other agents will try to sell you a permanent insurance. And I'll show you what the challenge is for that, okay? So let's just say you're someone that needs $1 million worth of life insurance, okay? If I was to sell you let's say a 30-year term, which is the longest amount possible, that would get you to, let's say, about age 55, okay? So I would sell you $1 million term. That is the simplest and most inexpensive. But then the challenge is, after 55, you have no more insurance. So then what do? You may not be able to get any type of other insurance because you're not insurable or it becomes way too expensive. Okay, so that's term. Another agent may come along and try to sell you, well, hey, let me give you $1 million in permanent, okay? I'll give you $1 million in permanent insurance to last you your whole life. The challenge with that is it becomes cost prohibitive. It's very expensive to have $1 million in permanent coverage. What I like to do is what's called a blend. And by general rule, I do sort of like a 75%, 25% blend. And here's how that works. So I will tend to come here and say, okay, well, let me give you $750,000 of coverage for a term policy for 30 years. And then I'm also going to give you $250,000 of permanent, okay? And that's so that when the $750,000 of life insurance company runs out, you still have protection. Within that 30-year time period, the combination of the 750 term and the 250 permanent gives you $1 million of coverage when you need it the most. Because look, let's face it, this is not a perfect situation, right? Maybe we haven't saved enough for retirement. Maybe we haven't met our goal. Maybe we've come down with a health concern and we have medical bills. And so most people, when they finish their term, wish they would have something left over. And so I recommend this type of model. And if structured properly, your $250,000 can actually go up because if you have invested in permanent life insurance, you can have an increasing death benefit, and this also serves as supplemental retirement account.